Hello and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new edition of Big C. I'm Manisha Gupta and with me is Nigel Dsouza, back with your daily dose of commodities, cryptos and currencies.
Well, we've got an interesting lineup for you on the show, but also before we get to that, let's do a quick check on what's going on in the global equity action. Both the Dow and the S&P 500, they closed the session lower. Meanwhile, the tech-heavy Nasdaq will manage to eke out some kind of gains in yesterday's trading session. It managed a record close, largely led by Nvidia, after the company said it hopes to resume chip sales to China soon. Stock futures, however, are trading a little bit in the red as the street eyes earnings from banking majors. The likes of Bank of America, Goldman Sachs, as well as Morgan Stanley will be reporting their numbers. All eyes will also be on economic data coming out of there, the producer price print for the month of June. Well, stocks in Asia Pacific, they're trading mixed after the US President Donald Trump announced that a preliminary agreement with Indonesia has been inked with around 19% tariff on exports into the United States. So lots to look forward to. For the time being, overnight, the markets ended a little bit lower, though the Nasdaq was a relative outperformer.
Oh, yes, it was. And shifting focus to the crude oil prices, and the prices have snapped its 2 days decline as demand from the two biggest economies of the world, US and China, show signs of improvement. Meanwhile, the dollar index continues to hold gains ahead of that June producer price report from the United States. In fact, the dollar is also getting a slight fillip from the headline inflation report expectations, which has inline expectation at around 2.7% on annualized basis, but still higher than the Federal Reserve's tolerance levels. Well, joining us now to talk about that and more is Vishnu Varathan. He's head macro research, Asia ex Japan, Mizuho Bank. Vishnu, hi, thank you so much for joining in. There's just so much happening in the world, but all eyes on the US inflation data. What are you anticipating? If it's hot, then what is it? And if it's not so hot, then what is your expectation?
Yeah, I mean, that's a really good question. And I think you pointed it out correctly that, a lot of people are watching the inflation data. So simply put, the inflation data is probably what's going to stand in the way of the Fed beginning or resuming its rate cuts. And for the time being, I think the consumer price index had enough red flags in it such that, they're discounting, basically written off the chances of a July cut and diminishing the odds and the bets on a September cut as well, primarily because, not because the headline number in and of itself was unacceptable, but more because in the details, there were some signs that there's a seepage of the tariff effect, coming through on a month-on-month basis. And I think the fear is if this is sustained, then the Fed might be holding back based on the uncertainty around inflation expectations. All the watching around PPI is just a matter of validating these fears. And I think that's probably what's going to frame markets, which is what's probably going to hold up yields, maybe dampen the equities, and add some, a little bit more traction to the dollar.
Hi, Vishnu. Good to see you. When, one wonders what can dampen the equity markets because they are just taking the bad news and, bracing for more. A couple of questions then. I was looking at the Fed rate futures. The prediction is now we'll get around, I think, 44 basis points in comparison to around 50 basis points odd prior to that CPI number. What are you factoring in terms of rate cuts for the remainder of this year? If you could help us out with that. And on the yields, that's crept up a little bit, 4.4% to thereabouts. Where do you see bond yields headed? Please go ahead.
Sure. I'm going to take the bet on the other side, which is I think the scope for more cuts, not fewer cuts. Not because I am, exceptionally optimistic about the tariff outcomes, and so I don't believe that there'll be some price pass-through. But on the other side of things, I think it's going to dampen demand sentiments a little bit more. Already we see U.S. households, the average U.S. household being somewhat more cash flow constrained. I know there's a lot of analysis that the budget is going to front load the stimulus, but that by and large will not alleviate a lot of the cash flow strains for average households. So I expect that the 2 rate cuts the Fed said they will deliver this year, that will be easily done. There's actually scope for another cut.
Wow.
So they could go as much as 3 this year. And we're probably factoring in more next year. But of course, it's a lot more complex given the change of the Fed chair. And to the question of the yields,
yes,
I think front-end yields will move a lot more, but you were referring to the long-end 10-year yields. I think that's going to be volatile. It's probably going to shift down towards 4% if the Fed starts cutting. And if they do communicate that they expect inflation to be a passing phase rather than something that entrenches in expectations. But between now and there, there's a lot of two-way volatility around fiscal expectations and fiscal risks. And for those reasons, I think we should expect a much steeper curve and a very volatile long end.
Well, interesting. But yesterday's print rules out any kind of near-term surprise, as we spoke about earlier. So the first cut comes in September?
I'm still taking a view of a September cut. And to your point, and that's a really good point, I don't think the inflation numbers in itself is going to surprise in a big way and move the needle and make us jump out of our seats. Rather, it's the narrative around it. So what do you believe this inflation means? Does it mean there's a lot more demand pull from where that came from? Or does it actually mean, you know what, this is a price shock that's going to exacerbate the pain that households feel? So actually, they're going to consume less, not more, given that they'll be less left in their purses and wallets.
Vishnu, with that kind of a background where you're expecting 3 rate cuts in this year itself, would you say that the dollar has baked that in? Because for the dollar index as well, it has been a very volatile year, from a near 4-year low of 96.3 and a high of around 110 to trading to 98 right now. It has been volatile, still trading on the lower side of the range though. One, has dollar baked all of this in? And two, how are you looking at the dollar index ranging now for the rest of this year?
If the dollar had a Facebook account, then it's going to say it's complicated because I completely take your point. If the dollar hasn't fully baked in the Fed rate cuts and going by markets pricing, they haven't, then the dollar should in theory decline. But the thing is, the dollar has also front-loaded a lot of the weakness that came through from the tariff fears, the Sell America narrative, and to some extent the de-dollarization theme, a lot of which are stretched, and a lot of which relied on the euro being continually bid up. So that's what complicates the dollar's picture. I think if the Fed is in a position where they're going to cut more, chances are the other major central banks could also relent and cut more, whether opportunistically or seeing the need as such. And so for those reasons, we think the dollar will soften from here, but not collapse. So we're looking at the dollar remaining in the 95 to 98 range as it gets into the end of the year, not all out going and collapsing below 92, which is where it was before the Fed started its hiking cycle.
And while the Asian currencies have seen some support as well, but not so much. I mean, look at the Indian rupee or the Chinese yuan for that matter. We haven't done very great. What has done great, though, has been Swiss franc and euro, with more than 12% gains in this year until now. How are you looking at the Asian currencies vis-a-vis the high-yielding currencies?
I think you hit the nail on the head, which is, given that the dollar has collapsed anywhere between 10 to 12%, depending on your reference point this year, Asian currencies have taken a rather middling path. Taking away exceptions like the Taiwanese dollar that jumped in a big way. I think Asian currencies have very much underperformed versus majors. So whether it's the euro, the Swiss franc, and essentially not holding their own. And in some of the, even if you use the broad brush and say, look, Asian currencies have by and large been resilient, that's been under the cover of a very bearish dollar. So the veneer of resilience could get tested as we get into the second half of this year. So even as we expect the dollar to soften, we don't think that means it's a stable environment for Asian currencies, and certainly not one that allows Asian currencies to showcase strengths. Depending on the mercurial outcomes of the trade deals, so on and so forth, a lot of volatility is left on the downside to the Asian currencies. But we don't expect a very large sell-off insofar that the dominant theme is probably going to be the dollar theme, and a little bit more softening is left in it.
You want to put a level to the dollar index? We're at around the 98 odd handle. The recent low was around 96.5. Some calls are, calling for 90, while others say that maybe in the near term we'll see some kind of stability. It stabilizes in that band, 95 to 98. Which side of the fence are you on?
I'm smack in the 95 to 98. That's where I sit with where it is. And I will add one more, aspect as to why Asian currencies, even though it's going to have some downside volatility, they may not sell off in a very large way. Because one of the peculiar trends that we saw is re-emerging. And this is something we saw from mid-2021, where US inflation was a lot higher than Asia's inflation. So the real pickup in Asia was much better, supporting Asian currencies. We're going to see a little bit more of that again as the tariff price shocks push US's inflation higher than Asia's.
And that's exactly the point that we have to speak about, because we're talking about currencies and inflation and interest rates. What is the impact of tariff on all of this?
Yeah, I mean, so we're basically taking a step in the dark, blindfolded, as if we didn't need it, as if we need another blindfold. But I think this is the overall outcome that we're looking at. For tariffs, I think the tariffs are going to dent the top line. Initially, there's going to be a little bit of relief that should boost Asian currencies. But I think in so far that the top line actually gets dented, and that's got a knock-on impact as it cascades down. And by and large, maybe less so for India, but more so for ASEAN, we're probably going to see a lot more of China's excess capacity making its way into the region, suppressing profit margins, so on and so forth. And that also will probably have a little bit more of a drag factor on Asian currencies and the growth prospects. So these are particular flows that we're looking at and looking at how they take shape. Because I think a lot is out there, and we don't know exactly the path it's going to take.
Vishnu, as we wind down this conversation, a quick word on various asset classes. I mean, we're looking at how the currencies are behaving, and how would you look at perhaps equities or commodities, gold, the safe haven bank that we've seen onto that one? How are you looking at a rippling effect of all of this in many of these asset classes?
I think there's going to be a rethink of how to allocate across asset classes for two big reasons. One is the tariff impact is going to cause not just inflation in the US, but possibly a divergence of inflation between the US and the rest of the world. The rest of the world could be dealing with more disinflationary Chinese forces. So I think where equities are concerned, equities will probably still provide a little bit of that inflation hedge because of the nominal terms in which it's valued, so long as we make it through the sectoral tariffs, because that's going to cause a lot more reordering in equities. So I think equities will remain fluid, but overall the allocation there should remain fairly good. But because we also see a much steeper yield curve coming about, I think in the fixed income space, there's going to be a little bit of back and forth rather than an all-out pickup, even as the Fed cuts. So those are what's coloring our view of things to come. And as you rightly pointed out, I think the world is in a place where they're looking for alternative safe assets. So gold has certainly benefited as crypto. But I think a wider AAA European space, in the European space for currencies, could also get a little bit of a leg up as the global reserve diversification continues.
Vishnu, I appreciate your time. I can't get over the line where you said if dollar index had a Facebook account, it would say it's complicated. Well, absolutely. The kind of decline that we've seen for dollar index hasn't improved or supported Asian currencies as well. But it is the major or the yielding currencies which have done quite well.
And I think if it had a Facebook account, the first one that would be unfriending it could be Donald Trump. Because he's been making all those rise, was a friend.
Well, yes, we already created a Facebook account for dollar index here. But thank you, Vishnu, as always. Thank you so much for taking time out for us. We'll speak to you yet again very soon. But for now, it's time for a short breather on the show. On the other side, we will talk all things crude with Omar Najia of BBenergy Gulf DMCC.
Welcome back. You're tuned in to the Big C. Well, let's welcome our next guest. We have Omar Najia, derivatives trader, Gulf DMCC, who joins us on the show. Hi, Omar. Good to see you, and thanks a lot for joining in. Crude oil prices, it was hovering around that $67 a barrel odd. And then, in fact, we had the OPEC said they're going to pump in more amount of supply. One would have thought we'll see a bit of a downtake, but surprise, surprise, it's closer to around $70 per barrel. The underlying demand actually has been a little bit weakish. How do you read the trends from year on? And if you had to take a 12-month time horizon, where do you expect crude to go?
So the big picture view is crude is going considerably higher. So OPEC, I think, is trying to, it's quite funny. Since we set a low back in kind of Mayish, OPEC have done nothing except say, we're going to increase production, we're going to put this. Every time they say that, market rallies. So basically, the idea is that oil, in real terms, is extremely cheap. So if you look at the price of oil and you compare it to the price of anything, the price of gold, price of Bitcoin, price of the S&P, price of the Indian rupee, anything, it's at lows. It's extremely cheap. And I think the biggest kind of driver for oil isn't, supply and demand and, 1 + 1 = 2 and all this kind of stuff. It's basically money flow. It's basically the fact that the world is massively inflationary. It's the fact that you've seen the dollar, like your previous guest was saying, drop 11%, and I think is going to drop a lot more. We think that the dollar index is going to go past 90 down to 87.
Wow.
And all that basically is pushing asset prices, real hard asset prices up. And under that comes commodities. Now, of course, oil is consumable and all this kind of stuff. But still, I think basically you're going to continue to see dollar weakness, dollar debasement. The Fed is definitely going to cut. And why is the Fed definitely cut? It's got nothing to do with inflation. It's the fact that the US needs to borrow massive amounts of money. They need to refinance about 9 trillion of debt, which is coming due this year, 9 trillion. And basically they need rates lower because they need to refinance that debt. So they're going to cut, even if inflation goes up to whatever it is. And they're going to tell you, yes, CPI is 2.1 or 2.2 or 2.7. Makes me laugh because if you look at the real kind of guy in the street and you ask him, how much are you paying for education? How much are you paying for transport? How much are you paying for houses? It's not 2.7%. Everybody knows it. So they can come up with these numbers and say whatever it is, but inflation is going to skyrocket. You've seen China do stimulus. You've seen basically the US, you've seen the EU come up with $1 trillion for weapons manufacturing. All this kind of stuff is stimulatory. So I think basically oil is going to go a massive amount higher. I think over time, we've started a new bull market. Over time, we'll see new all-time highs. So higher, undisputably higher. I don't think anybody can look at oil on a strategic basis and say, you know what, everything else is going up. All assets are going, house prices are going up, inflation going up, gold going up, stock market going up, everything going up, but oil, it's going down. So I don't think that's going to happen.
All right. Omar, I'm just stuck at these levels right now. You said dollar index could go to 87. I mean, that's a number I haven't heard anybody else say. How are you justifying that?
So basically, we've been right. The dollar index since the beginning of the year. For 110, we sold it.
Right.
We bought it back yesterday because we weren't too sure about this bounce, but it's bouncing strongly now. But I think basically this bounce is a corrective bounce. It goes from this 96.3 kind of level up to about 102, something like that, and then it's gonna come down in a big way. So again, if you look at things purely from first principles, simple stuff, you don't need to look at all these reports and 2.1 and so very simply, you have the US. The US has historic debts and historic deficits and interest rates which are high. The only way it can manage that debt is by deflating the dollar. It's been doing it for 40 years. So when you say to somebody, oh, it's going to go to 87, oh my God, really? Why? Well, because basically it needs to deflate. They need to monetize this debt. With Trump having passed the BBB, right, which is basically you can add about 3.5 trillion of debt, and the BBB front loads that spending now, and then first you spend I don't know how many trillion, then basically you cut, 5 years down the line. They're never going to cut. All they're going to do is what they've been doing, which is spend. So the dollar needs to be weakened, needs to be debased. There's no hope of them ever paying back this 37 trillion. So I think that they're going to, and they need the way that people aren't buying treasuries, which is why they're passing this, Genius Act and the stablecoin bill and all this kind of stuff to get stablecoin companies to buy treasuries. So the US can't sell their debt, which means basically dollar gets weaker in real terms, which means emerging markets get stronger because emerging market debt is in dollars, which means basically a lower dollar is inflationary across the board, inflationary for the world as a whole. So I think, dollar index gets from 98 gets to maybe 1 or 2 on this corrective bounce and then gets smashed down to 87.5.
Omar, coming on the crude prices as well, and most of the reports suggest that we could be looking at mid-60s, higher 70s in this year, and the next year could be looking at prices declining further, even down all the way to below $60 a barrel as well. You're talking about much higher numbers. What is your sense on the crude oil prices this year and the next year now?
So I think you have to look at this in terms of short term. The long term is basically it's going up and going up a lot. The question is it going to do it from here, or does it do it from slightly lower? I don't think Brent is trading around 69.50, call it. I don't think you're going to see Brent dip below 60. And I think you're going to see it take out 80. So if I was guessing, I'd say you see over $80 by the end of this year, and I think next year you'll see it. You'll see triple-digit oil. I think basically people are underestimating the shifts that we're seeing in terms of what's happening on the fiscal front, and what's going to happen in terms of the wars in the Middle East and the war with Ukraine and Russia and all this geopolitical instability. So we are bullish. I think basically end of this year we'll see Brent over $80.
Over $80, all right. So what are you factoring in then? What will OPEC's action be from here on? If you're going to see that's the two big calls you're making is that dollar index sees a big 10% pullback from here. And you're in minority, but you believe that crude oil prices are going to race off to the triple-digit mark. So factors at play. OPEC's role, hopefully there's no geopolitical risk.
What will the US president do? Omar, you're not in good books right now.
He's talking
the
about
US
drill,
president is not going to like you.
Drill, baby, drill.
Yeah, but I mean, that's Trump when he came in. He said, drill, baby, drill. He also said they're going to cut spending. He also said they're going to stop wars. Yeah. And, he's done absolutely nothing on all that kind of stuff. He also said he was going to deport a lot of people, which he didn't do. So on every front, basically, they've said a lot, but they haven't done very much. So they haven't been very, quote unquote, successful. So basically, it's like the same thing. It's like you had Biden and you had Trump, and people were looking to the same direction, and it's like all they did was, like, if they were traveling on a highway, they changed lanes. So basically it's the same highway, they just changed from one lane to the other lane. Direction is the same: print more money, spend more, bigger deficits, bigger debt, weaker dollar, more wars, blah 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 blah. Exactly the same.
All right, Omar, fun talking to you, and we hope to speak to you yet again very, very soon. And as Nigel said, you are in the minority, but those are very, very interesting views that you put forth, whether it comes to inflation, interest rates, global demand, or it's about dollar index or the crude oil prices. I mean, $80 to $100 a barrel in the next year is something that the markets perhaps will not like, but all the points that you put forth do make sense there. Thank you so much for your time. And with that, that's all the time that we have.
Thank you very much.
Thank you. With that, that's all the time that we have on this show. It's goodbye from me and Nigel for today. Thank you so much for watching. We'll return back tomorrow with more news and updates.